Right. Good evening,
We hope.
colleagues. Welcome to our long-awaited webinar on managing risks during periods of uncertainty. We do hope you and your loved ones remain safe, and as we continue to experience the effects of this pandemic, albeit we're not really seeing or experiencing that much in Jamaica, but certainly we're seeing the impacts of it across the globe. My name is Wint, and I am the treasurer for the CFA Society Jamaica. I am also a risk management professional with over 25 years experience in the financial services sector, and also an executive director of the Prime Contact Secretariat at the Bank of Jamaica. I will be your moderator for today and ably assisted by Mr. Dane Brodber, our technology coordinator, and Mrs. Narisha Farquharson, our programming chair. Today, our panelists in order of appearance will be Mr. Dane Brodber. Dane, you can just wave your hand. Dane is our founding vice president and the chief risk officer at Cornerstone United Holdings Jamaica Limited. That's a parent company for Burrito. Much of Dane's 17-year experience or career has been in market risk, which included responsibility for market risk in the Caribbean and at Scotiabank. Dane has an MBA in addition to his CFA and FRM designations, and is also a chartered alternative investments analyst. Our second presenter or panelist today, is it possible for us to mute some microphones? Let's see if I can mute all. Okay. All right, great. Sorry about that. Mr. Damion Brown is a director of the CFA Society Jamaica and chair for our public relations committee. Damion is, in his professional capacity, is the group chief investment officer at the Jamaica Money Market Group, and has over 17 years experience in the financial services sector in Jamaica and Bermuda, both from a corporate and regulatory perspective. And our final panelist today will be Ms. Monique French. Monique is our resident governance committee chair and a director of the CFA Society Jamaica. She's presently the group chief credit officer at the CIBC First Caribbean International Bank across all presently 16 territories in which CIBC First Caribbean operates. Monique has extensive experience in the financial services industry, including leadership positions in risk management, treasury, sales and trading, reporting, and analytics. Monique is a professional with a depth of expertise in treasury, retail, small business, corporate, sovereign, and private banking segments, and has served in various committee, nonprofit, industry, and economic committees and boards. Monique has held the CFA charter since 2000, in addition to holding a BSc and MBA in degrees, completing the CSC, that's the Caribbean Securities course, and Financial Risk Manager designation. So here you see, guys, we have a wealth of experience and knowledge, and we hope to just share that with you today, and also to get some perspectives from you as we proceed through today's webinar. Now, just a little bit of housekeeping before we move on. Today's conversation is geared towards providing you with some practical information to better identify and manage uncertainties, what we know as risks, that increase or emerge during crisis times like this COVID pandemic. We'll seek to highlight some themes, issues, challenges around key risk areas such as enterprise risk management, operational risks, market and liquidity risks, portfolio risks, and credit risks. So we do hope it's very insightful for you. The first segment will have each panelist providing opening remarks on specific risk areas. Thereafter, we'll segue into our panel discussion. Throughout the panel discussions, we will have polls administered to gain your insights into various issues being explored. So what we'll do is we will poll the questions. You'll have an opportunity to respond. You'll see the polls flash up on your screen. You'll have an opportunity to respond while we're having the discussions. And then we'll take the responses of the polls at the point where we're doing some question and answers, so we can incorporate your perspectives into the discussions. The session is expected to be very interactive. In light of the webinar, however, we wish that you ask the questions via the chat box option, and our able assistants will actually direct the questions on your behalf. So we're providing you with that opportunity to just share with us through the chat box option. To minimize noise interference, I know I have muted the microphones just now, but I've allowed you all to also unmute when you need to. But I'm gonna ask that if you unmute, that you put the microphones back on mute if you're not speaking. All right, that will limit the noise interference. Our sessions will also be recorded for your benefit and for later access, and for access for those persons who were unable to make the webinar today. All right. Now, I will start the discussion on enterprise risk management and some elements of operational risk insofar as business continuity, for example, and how the COVID-19 pandemic has impacted organizations from that perspective. Now, I know we're primarily risk professionals on this video conference today, on this webinar today, or persons who are exposed to risk in some way, shape, or form, whether it be in a professional capacity or in a personal capacity. So you actually have a perspective already on what risk is or what enterprise risk management is. But certainly to refresh you, you know, when you talk about enterprise risk management, it's really a structured and very consistent and continuous process across any organization to help them to identify and assess risks and making decisions and responses to those risk assessments, and to provide reporting on those exposures to their senior management, to board, and in some instances to even share those perspectives with your customers, depending on the types of industries that you're in. Now, when people talk about risk, you typically think about the negatives, but the reality is you have positive and you have negatives. The positives are really the opportunities, right? You look at the opportunities, you look at the threats, and the negatives are the things that would prevent you, or those impediments that prevent you from achieving your strategic objectives. Okay? If you think of it from that perspective, it will help you to be able to also think of the myriad of risks that could potentially impact your organization. Today's conversation will focus primarily on the financial elements of those risks. So we talk about credit risks, portfolio risks, liquidity risks, and market risks. So that is the enterprise risk management perspective. Now, the significance of this for an organization is typically to focus on your business strategies, right? And this is not limited to you as a risk professional. This is really where senior management utilize the services of risk management or the perspectives of risk management to help them to focus on business strategies, revenue protection, which is key for any organization, and to look at your targets and ensure that you're maintaining your targets. Think about alternative revenue channels where you're faced with negative implications or faced with uncertainties. You know, when you think about the times of this COVID pandemic, you know, people have to now consider what are some of these alternative revenue channels, because you recognize that, you know, your primary revenue channel might very well be underwater or non-existent, or may very well be non-existent in the future because of the changes that COVID has had on your organization. It provides sight of threats to achieving the objectives and helps you to look at opportunities arising from, you know, the risk event. So for example, You think of organizations that have a particular, I mean, you think about our clients, or they're in a manufacturing business, for example. Certain levels of demand would have declined because of the COVID pandemic. You know, farming, the tourism sector would have shut down. The demand level for certain end products would have declined. Persons have to now start thinking about what are the alternatives for that level of production. You know, what are those alternative goods that can be produced for that segment? Some may have to think about what are the byproducts that they could use or they could produce, and what segment of the market, their new target segment of the market. Enterprise risk management also helps you to look at how past, present, and future environments impact your business strategies. So, for example, it looks at the impact of this pandemic on, when we talk about, you know, schools being out, for example. Children have to now access educational tools and materials using technology, broadband access. You know, how does that impact, you know, children from our rural communities, for example? You know, start thinking about what those new business strategies will be for an organization to produce those new or increased level of demand products for that segment of the market. So it gives you the opportunity to start thinking about, you know, new business strategies, or adjusting the business strategies in order to be able to manage post-pandemic or post-COVID. When you think about the operations of your business now, you start thinking about, you know, what are some of the implications of the COVID pandemic on your business operations. Don't think only about the financial services sector. Think about any sector. You know, what are some of those implications? Do you have appropriate business continuity measures in place to be able to continue with your operations? I know everybody is talking about this work from home. This is nothing new for any of us. It may not have been a new consideration, but certainly it is now a reality for most companies, if not all companies. So you have to now start thinking about, if you didn't start thinking about them before, what are the risks associated with this new work from home paradigm, right? Confidentiality matters. How do you address those confidentiality matters? Because you now have your team members working from home, accessing or sometimes even taking home confidential data outside of an office environment. How do you ensure that level of productivity continues? Some of those are some of the things that you have to start thinking about, if not thought about already, and how you're going to address them. That all rolls up into your enterprise risk management, your business continuity planning for past, current, and your future planning, right? I'll just segue into our first panelist, right? We have the first poll question here. Persons are going to be asked to just respond to the first poll question. However, I will just turn over now to our first panelist, Mr. Dane Brodber, who will provide some insights on liquidity and market risk. Dane?
Yeah, thanks, Hope. You know, definitely an interesting time to be in risk, and probably a more interesting time to hear from risk than before. You know, it's you know, all areas of risk are pretty much being tested. I think, you know, business continuity and liquidity probably get most quickly tested, and then, you know, depending on your susceptibility to market risk, and then eventually credit risk and other operational risks such as IT. But, you know, this is kind of unique in that, you know, it's a paradoxically unusual stress event. I mean, we've become accustomed to modeling for stress that we kind of figure we know the usual suspects, and we kind of train ourselves to detect and model them. But, you know, typically we anticipate systemic liquidity stress, for example, to come from, you know, the realization of some fundamental weaknesses in financial systems. But this one really came from business discontinuity. But I think the good thing is that, you know, I think the market this time around was a lot more prepared. Liquidity definitely has gotten way more focused since the 2008 financial crisis. You know, I remember when I did the FRM back in 2007, think I remember a paragraph on liquidity throughout the syllabus. You know, I think it's probably the risk area that gets the most attention. You know, from short-term liquidity, stress resilience, structural liquidity, contingency planning, a whole bunch of stuff. I think central banks also have been more sure-footed. If you look back at the global financial crisis, I think the Fed took about up to 19 months to come with a lot of the various non-standard responses. And you know, for this one, I think most of those were implemented in about a month. And I think between our industry associations and regulators, we're in good shape as well locally. Of course, you know, one of the ways that we as practitioners prepare is through liquidity contingency planning. And I'm sure a lot of us would pretty much be in execution mode at various levels. You know, like most of the responses, you know, your crisis readiness really tends to be a function of your risk discipline, especially in good times. And, you know, it includes a well thought through plan, you know, adequate testing so that the various actors know what they need to do, ensuring the operational capability of the various response options, and very important, the depth of the relationships with the customer base. And of course, in actually managing through the crisis, a couple other factors become important. You know, being nimble in how you evaluate different counterparty classes, being thoughtful about the range of crisis responses, leveraging those relationships with your customers and other stakeholders, and you know, the operational execution of those responses I mentioned before. And you know, even though we're kind of in a, I guess, somewhat of a steady state crisis now, it continues to be important. I mean, the full effects are not yet known. Liquidity is usually a function of surprises or liquidity risk. And, you know, I suspect we'll kind of hear more from Monique to get a sense of what we're in for. But, you know, an important and interesting thought going forward is going to be how governments and central banks unravel this response. You know, how will they relieve the market of all the liquidity that's come in? How are governments going to pay for all the stimulus that they've put in? And, you know, a lot of it is going to depend on the recovery and, you know, how ordered that will be. So, you know, because of the unique nature of the situation, you know, it largely involved navigating and pivoting around, you know, our traditional liquidity and interest rate risk assumptions and how they act differently in the crisis. You know, especially, you know, your behavioral characteristics like, you know, the rollover rates for deposits or attritions for non-maturity deposits. You know, even contractual arrangements you have to kind of think differently about. You know, from the market side, you look at the yield curve shifts and how you have to decompose that, you know, between your base rates and the actual spreads, which you know would have moved in different directions. But you know, I think in all of this, the interesting nexus to balance, you know, which I suppose is common to pretty much most lines of business, is taking into account the differences that we're observing, but with the understanding that this is really a 100-year phenomenon. So, you know, I think the key thing is to use this as a data point to become more thoughtful about our assumptions. And, you know, in a sense, probably separate the business discontinuity from, you know, your sort of generic crisis responses and manage in a way, you know, through resilience to typical stress events and good contingency planning for, you know, for unusual stress events such as this. So, you know, while we're doing all this thinking and remodeling, you know, I think particularly for fellow practitioners, our personal stress resilience would have been tested with the several stress tests that we've been doing, both ones that we do internally from a prudential standpoint, and, you know, those that our regulators have gifted us with. But I mean, what it really does is give us several opportunities to evaluate our risk capacity. You know, what does our risk-taking ability really look like, having considered all of these events? You know, typically you're most concerned with liquidity and capital adequacy. But if those are tight, you know, your focus will typically be on, you know, building resilience and ensuring the adequacy and operational dexterity of your recovery options. But, you know, even risk-off approaches can be challenging. You know, for example, balance sheet management, you know, what does matching a balance sheet now really mean when a lot of the behavioral variables are not as easy to model anymore, you know? But if there's a lot of capacity, it really gives you a lot of room to take advantage, you know, of the discounts that uncertainty in the markets offer. You know, there are lots of opportunities now to take a well-considered view. I mean, depending on which market you're in, you're going to see it reflective of a combination of, you know, an uncertainty premium, you know, because we don't really know what the extent of the pandemic or what's going to happen going forward. You know, it increases risk premiums and weighs on asset prices. And in some sense, there's also some rescue factors that I think may, in some cases, be reflective of premature recovery. But, you know, there's an opportunity to really embrace all this uncertainty as long as we have a healthy respect for it. So, it's really a challenging time to be a risk manager. And I think, as a practitioner, you'll enjoy it more if you're open to thinking critically and, challenging assumptions. All right. So that's me.
Thanks for that enlightening discussion there, Dane. We'll take the questions at the end, and I certainly have some takeaways from this that I also want to have, to discuss a little bit more with you. But until we get to that point, the second poll question has been launched, everyone. So we ask that you just go through that. And we'll have in the interim, Damion Brown now doing his brief presentation on portfolio risk. Damion.
Thank you very much, Hope. Good evening all. Let's take a high-level look at how you construct and manage a portfolio. If we recall, constructing a portfolio normally involves a strategic allocation that is expected to generate the desired return over time with some amount of fluctuations within each period. To ensure that the risk is acceptable, we seek to limit the amount of fluctuations by adjusting the assets and the potential downside, and do an iterative process to get to the desired risk versus return trade-off. This is adjusted and fine-tuned over time until the portfolio is consistent with both your financial objectives and your strategic objectives. Normally, if there's a short-term material disturbance or expectation that there could be a fundamentally different outlook in the market and the economy, there's a tactical shift to reflect the short-term circumstances and to ensure that your risk-return dynamics reflect the underlying reality over a given period of time. Now, no portfolio manager with experience will consider that they have a crystal ball and will know that exactly what asset returns will occur within a year is not where you focus your energy, but to ensure that you have a properly constructed portfolio that will get you to your goals over time and have a fairly tight fit in terms of your risk to return objectives. You construct your portfolio based on fundamental research and based on historical results and data analysis, knowing full well that there are risks to your forecast and hence the deliberate diversification within the different asset classes and across the specific entities. However, the major risk to this approach arises in situations like this, when the movements are totally inconsistent with what generally occurs within an economy, and the underlying fundamentals of the assets change significantly during a short period of time. Remember that most financial assets are ultimately claims on underlying cash flows and financial positions of entities and governments, or a derivative based on such an asset. With the impact of the COVID-19 virus, however, there were two distinct factors that drove the overall risk. The first one, we saw, and it's something that we are familiar with, that during financial and economic crisis, there is contagion. There is a factor that drives fear and causes a disruption in liquidity and investor confidence that causes almost all asset prices to fall in unison and creates a reinforcing downward spiral until either liquidity is injected or some confidence boosting measure is taken by the authorities or government. Some of the diversification benefits within even a properly constructed portfolio go way out the door for a period, and almost everything appears highly risky based on the price movements. The global financial crisis was previously considered a 1-in-100-year crisis and unlikely to recur, especially given the changes made to market infrastructure, the ability of regulators and central banks to respond, and financial regulation and upgrades in risk management arising from the crisis. However, COVID-19 clearly had different plans. We saw something unprecedented in modern times with respect to the lockdown in economic activity across most sectors. Disruptions to individual lives that were unprecedented and heightened social anxiety. And the disruption was almost across all geographic regions. We have seen sectors that are fundamentally not linked together start experiencing similar issues in terms of disruptions to revenue, disruptions to cash flow, as the impact of the lockdown in economic activity cascades across the economy and over time. Additionally, the fact that the nature of some activities that involve crowds or crowd settings may be fundamentally changed going forward, even after health restrictions are adjusted, will impact how some sectors evolve or even if they survive. Some key questions we all have going forward are, how will the various economies and geographic regions do over time? What really is the outlook for some of the companies with respect to changes in consumer behavior? How long will it take to recover from the damage that has been done? I don't have a crystal ball, nor will I look to predict the answers to these questions, but there are some very important lessons and considerations coming out of the crisis and going forward. One, to understand exactly what are the fundamental drivers to returns in your portfolio. I think we'll have to go beyond just the normal sector classifications and industry classifications and really understand what are some of the behavioral changes in our economy or in technology or in disruptions in infrastructure or regulations that can impact your portfolio, cutting it through a different angle. What kind of economic and other factors will most likely inhibit or propel the sectors going forward? We've spoken about the damage of COVID-19, but we have seen that some technology companies have actually materially benefited as people shift to working from home and more remote-based activities. It's also highlighted, yet again, the benefit of having prudent risk management. People normally get paid for the returns they are generated and not for the losses that they avoid. But risk management is a key aspect of wealth creation over time. Increased focus on underlying cash flows and access to financing. The one I think that is of most impact is the importance of liquid assets to address the traditional cash flow needs during a crisis, but also to take advantage of opportunities when there's limited liquidity in the market. Understanding your shortfall risk, how bad can your returns go, and what are the implications of that for your organization and your lifestyle. And an increased focus on credit risk and the ability of the underlying entities in your portfolio to survive and their resilience. While policy responses have removed some of the downside risk and we have seen asset prices rebound in the global financial markets, one shouldn't assume that volatility is over and it's purely upside going forward. Changes in investor sentiment or data that is inconsistent with expectations can change investor behavior and quickly investor asset prices. We won't be able to avoid risk. COVID-19 has clearly shown that, but we have the ability to embrace the reality of it, and our ability to withstand its outcome can be improved, and also to ensure that we can benefit from it when it occurs. Thank you.
Thank you, Damion. Very enlightening discussion there. We have our third poll question up, and it's been up for about 3 minutes. We'll just give you a little bit more time to process that question. And in the interim, we will move on to Monique French, who will provide her perspective on credit risk. Monique?
Thank you, Hope. Good evening. I'm going to talk about managing credit risk in a crisis, and I'm going to try and lump that into 4 main areas. The first one is establishing your coordinates, then connecting with your context, creating your process, and then communicating clearly. And establishing your coordinates in terms of the starting point is to figure out when a crisis emerges, where are you in that? Are you at the beginning of it, the early stages, the middle of it, or the end of it? And sometimes if the crisis has had a precedent, for example, in the Caribbean, we actually have a lot of experience with hurricanes. And you may be facing one coming, having gone, having devastated, but the benefit of that is, as devastating as it is, you have a reference point. So that crisis has something where you can pull data either from your home country, from past events, or from a sister island. In the case of a crisis where you have no precedent, it is still good to establish your coordinates, because acknowledging that you do not know what you do not know is an incredibly powerful thing in terms of how you move forward, because it begins to say to you, you're going to probably have to phase your responses. And when you cannot establish where your coordinates are, it says that, okay, I do not know the depth, the breadth, or the severity of this, and therefore the key thing is to stop the bleeding. So it's recommended that the first thing you do is move with agility to ensure that the credit risk matters that are ahead of you and are urgent and can be fatal are dealt with in very expedient and quick handling. So do something, yes, with thought, but move quickly to make that first step of ensuring the patient does not die. As soon as you do that, and you've bought yourself some time, and that's the whole point of doing that, you now can step back and move into your next phase of beginning to connect with your context, because you are now going to move into from diagnosis into developing a program and what your next phase of longer term response is. And it's important for you to, first of all, step back and disconnect with some of what Damion and Dane said and get a context for what you are moving in. Depending on the org you're in and its strategy, its risk capacity, its liquidity, its financial position, and how it wishes to be seen in the market, your responses on a credit risk mitigation basis or a credit risk program basis may be very different. It may also depend on how you play in the market. A portfolio manager who is taking assets not on a relationship basis, but investing in paper without very strong client relationships may act very differently from a house or a bank that has very strong relationships and is seen as agent. And I think a master stroke of how you see this play out is Buffett. And so people were very critical of Buffett in this time. Some people who are lately comes to the thing, but if you watch Warren Buffett, what he's saying is who I represent in terms of my strategy, what I stand on, what my stakeholders expect of me. They expect me to last through many 100-year events. Cash is king for me right now. I do not know what is happening. I've assessed my coordinates. They say to me, high uncertainty, and therefore I stand on cash. I will be the ship that rides out anything here. So when you connect to your context, before you run off to do something, make sure it is consistent with what your ship can actually float, what storm it can float in, and that the actions you're about to do also do not ruin relationships that actually post-crisis, if you do survive, you have a bigger problem. And another takeaway from that is I remember in the financial crisis, Bear Stearns was actually not saved because in its heyday, it was so disliked and it had done so many things to save itself from risk, which were seen as Machiavellian, that when its turn came to be saved, its fellow peers did not wish to save it and said, I'll let you go under. So having connected to your context, you now need to move into designing a program around those credit risks. And as Damion said, at initiation, if you have done the work, if you made the right choices, if you are thoughtful, you should be a step ahead because you have taken on risks that were the right ones. And I think behaviorally, you have both a relationship and a commitment to those risks, which is much stronger than if you kind of just, shall we say, followed the market. In creating your process, it is also very, very important to remember the end-to-end. A lot of these risks we think of in silos, it might be driven by either the business area who has taken on and bears kind of that client portfolio or the portfolio area, or by the risk management area. I think that is a mistake. So when we take on credit risk and we're about to design a program, whether or not it is the type of shop which has a high, for example, a commercial bank with a real sensitivity to clients and how they are being affected, or whether it's another type of shop, it's really important to get together and ensure that engaging that process is the end-to-end of who internally will support making sure that that program happens. And there are a couple of reasons for that. One is you might be surprised. You think you are going to have a program that works, but you have some bottleneck or some gap you don't know about. In designing the program, there are a couple of things, because we're talking about crisis. So you're going to find that you are actually very concerned with time. Every day gone, you have to get a solution quickly. Still, this is a second step, but it's still important. You're moving quickly. So what actually will help you is to take a minute to pause, to connect with internal and external stakeholders. It is not the time to ignore talking to your clients. They are the ones who are going through it. And don't just talk to your clients right in the industries affected, talk to their suppliers, because very often you get insight. So the point is, as you go forward now to create your process, both internally and externally, move quickly, but ensure you are directly interfacing with the stakeholders who are being affected. Do not think that this is just a quant internal thing that you run some numbers and you know better and you run off and you do your thing. A key stakeholder in this process for us as financial institution persons are the regulators. And there are a couple of reasons for that. I think, and if we talk about the context of COVID, our regulators in the region have been brilliantly supportive. It's a give and take. Our information being fed to them of what we know about what's happening in our portfolio and what's happening with the persons who are issuers, with the persons who are clients, is information that allows them to figure out how and what they cannot tolerate, and also to feed back to us ways in which we can avoid doing things which may, for example, injure the larger systematic picture or trigger things that might create, whether on a national country scale, because they do have persons who are assessing the country strength systematically, but also regulatory matters, so we can avoid triggering issues there or triggering provisions and such things which are unnecessary. And it also just allows for an easier conversation when and if you need to do a second phase, which again, especially when it's an unprecedented crisis, you are often moving in phases. You go out with your program as far as you can see, and you hope that it resolves. And if it hasn't, then you have to re-engage. And if you're keeping your regulators and even your auditors engaged, it's a lot easier for them to come along with you and understand that you have done the work. So those are 3 points: establish your coordinates, connect to your context, create your process. Lastly, I come back to communication. The credit risk management and mitigants are something that your clients should know about, or they can't come and take advantage of them. Your staff should be very au fait on so that they can do their best with the clients. And also your regulators and auditors should understand. But lastly, yourself as management, as persons in there, you should have communication loops, whether it's reporting, and also to tie back to Dane and Damion's and Hope's presentation, to ensure the different risks are not living in silos. Am I seeing, having launched this program, something which is showing some issues in terms of another risk area? So those would be the 4 points that I would like to share in the open, and thank you very much.
Thank you very much, Monique. Very, very insightful perspective on credit risk there. We have the 4th and final poll in progress now. And I will ask, before we segue into the full panel discussion, I'd like us to just share the poll results for all 4 polls that we've done so far, so we can have a little discussion on those results. All right, so we could take the last one first. The financial institutions response. How do you think Jamaican and regionally owned Caribbean financial institutions are managing credit exposures and credit risks in the context of COVID-19? Most persons think we're handling it pretty well, over 50%, 58%. 34% think it's marginal. And excellent and weak, we have an even balance there at 6%. Our panelists, Monique, given that this is a credit risk discussion, what are your perspectives on this?
I think ironically that, and I say ironically just because maybe on the face of it, a lot of people would not have thought so. But again, people have underestimated that Caribbean banks have had to deal with crisis very frequently. I don't think most understand, especially for multi-territory banks, how the hurricanes and just the drills from that. And as Dane said, it is unprecedented, but you do learn to flex, you learn to learn. And I think that's an important part of being a CFA. You learn how to bring an approach to thinking and to respond. So I do agree that on the whole, the Caribbean banks, who have had a number of other things to distract them, notwithstanding, have done a pretty good job on average responding quickly. Most banks and institutions were out with offers even ahead of some of more, resourced areas. So I concur with the assessment.
And I agree. And I think from my perspective as well, I mean, we live in the Caribbean region where we experience more short-term but large impact, events. We have these hurricanes. Thankfully, we've not had an earthquake for a while, but we've seen the impact of earthquakes within our region. So we have an appreciation of the impact of these events. And so I think it has helped to prepare us and understanding our various touch points. It was interesting that you actually shared in your presentation as well, Monique, that, two key stakeholders that as institutions, we need to also just ensure that we maintain touch points with, and those are our regulators and our customers, because those are the people who will help us to better understand how the event is impacting them, and therefore how we need to adjust our portfolios to be able to continue to serve them and to be able to manage the impact of their ability or inability to continue to service the exposures that the institutions have to these persons. Dane or Damion, do you also have a perspective?
No, I concur. I think between Monique and yourselves, you've pretty much covered it pretty well. Definitely in the Caribbean, we've been exposed to a lot of credit events, so definitely we've been well trained there.
And I definitely think so in the context of the response by the regulators. As Monique said, they have been proactive and created a framework that is reflective of the realities and the unprecedented nature, and look forward as the various institutions work with their clients in what will undoubtedly still be a difficult situation for at least the next year in terms of the economic spillovers to get the best solution in a difficult situation.
Sorry, guys. We now have up on the screen the second poll question. What risk do you believe is of most significant concern for your, this is the first poll question. And it's interesting because what we're going to be doing as well is we'll launch this question after we have our robust discussion to see if your perspective changes. So the result on this one, what risk do you believe is of most significant concern to your organization during this COVID pandemic event? And we have an even keel here with credit risk and liquidity risk at 35%. And very closely behind that, and I would say, it's on par really, operational risk, and then to a lesser extent, but still important, interest rate and market. And I suspect that this may be because of the diverse community or team that we have on the call with us. But I think I'll take maybe Damion and Dane, your perspectives on the results here.
I think I'd put it over to Dane for liquidity risk, because you have to survive the shortfall, especially if you're a regulated institution. Um, People want to have access to their funds, and the day that they think that there's even the possibility that they can't have ready access, the value of your franchise has been inhibited. So that ability to, regardless of the situation, work through is important, and the first step to survive going forward.
Yeah. Yeah, I mean, I think the results are really a reflection of just, as I mentioned at the outset, that, pretty much every risk area gets tested, in this crisis. I think, credit risk now is the one that I think people sort of see and expect, and just kind of wait on the full impact of. And, liquidity risk, as I mentioned, is a function of surprises. So they've had an early surprise in the market, or an early significant effect in the market, largely from the market risk side. But, I think, liquidity risk continues to be on everybody's radar because of, the possible effects on the credit risk side. And of course, operational risk, Hope mentioned, business continuity. And, along with that and the whole work from home, type arrangements, you're going to see risks such as IT security, really come to the forefront. So really and truly, everything is on deck, in this particular situation.
Yeah, agreed. Monique?
No, I think the response, as I listened to Dane and Damion, just highlights how the risks interlink with each other. So even as we watched it, there were, clients who, what started as a credit risk became a liquidity risk for them, then it became a solvency risk, then it became something else. So the poor response makes sense to me, not just in isolation of each of the risks, but the fact that as we go through the crisis and how long it lasts, there's kind of an intertwining and evolution of one playing into another. So it kind of makes sense, especially that the credit and liquidity risks are twinned, if that's a word. For me, I see the operational risk as more something that can be managed. So maybe I would personally vote that as something which is, shall we say, something which exists, but it's a matter of managing it versus, to me, there are a lot more unknowns directly in terms of the crisis impact in liquidity and credit risk sphere of the matter.
Yeah. And I tend to agree. I'll also even extend it beyond just the financial services sector, because I'm sure we have persons, on the webinar who are not within the financial services sector, but certainly have responsibility for risk management as well within their organizations. And they're seeing the impact of being unable to either satisfy their obligations through liquidity constraints because of the pandemic, persons unable to satisfy their obligations to the companies, and therefore impacting their liquidity as well, and inability or ability to satisfy their subsequent obligations. So, and even in a personal capacity, persons may very well be looking at their personal circumstances as well, and recognizing the impact that liquidity and credit risk has on their personal portfolios. The third poll that we'll look at is, let me just share the results here. There is currently a disconnect between the real economy and asset prices across the financial markets. A resounding 63% are in agreement. We have a 20% in disagreement and unsure. Dane?
Yeah, no, I think it's not unusual that is the sentiment, but it's also not necessarily unusual that that's the result. If we just go back to the basics of valuation, financial asset prices essentially bring the future forward, right? So it's always going to be sensitive to change in outlook, and you'll pretty much tend to see those pretty much almost immediately. So pretty much all the key factors that would affect asset prices, there's a lot of uncertainty around it. There's uncertainty around growth. There's uncertainty around even just the level of risk that we're exposed to, and there's uncertainty about interest rates. So usually those are the main factors that influence financial asset prices, and usually the effect of any changes in those are pretty much going to be seen immediately. Whereas the real sector, you kind of see things playing out. You tend to see things playing out over time.
Sorry, we'll just take the final. We'll take the final poll question, and that is my admin team. The final poll question: when do you think Jamaica and the Caribbean region will see recovery from the effects of COVID-19? And that is to say, when do you think we'll have sustained opening of our borders, sustained government tax revenues, economic activity back in line with pre-COVID levels? We have 40, we're seeing 45% seeing recovery way in 2022. We have 2023, 32%, 2024 or later, 20%, and very few people think that we'll have a recovery by next year.
Wow.
Any perspective on that?
Wow. So we have a more conservative bunch that makes up the Moody's, Fitch, IMF, or anywhere. So we don't want them to go and take up jobs there, because then we'll have to put some very depressing assumptions into our provisioning models, and that will hurt. But on a serious note, we know that the Caribbean region across the board has done a brilliant job of within its borders containing COVID. We know that our sovereigns have generally sought to do what they can do, and that means going to, for example, the IMF for whatever, or the other markets for facilities to, so to speak, do what they can sensibly do without overextending themselves to support through to 2021. So we can see that far out. It appears that beyond that, our fate is a bit in the hands of the US. We know of countries that have sought to reopen and had to close back their borders because of the fact that most of our territories are tourism-driven territories. So for example, we know Bahamas had opened up flights and had to shut back that effort. So I think in a nutshell, the answer is we do not know. And to some extent, how this plays out will be a function of how our main tourism markets get themselves back in order. The exceptions may be countries which may have, shall we say, service-driven economies to some extent, which are not tourism-driven. We don't have many of those in the Caribbean, but we do have some higher income ones like Cayman, who have the financial service sector, for example, and that kind of thing. But the point is, if this drags out into 2022 in a very deep recessionary way, that's going to have a lot of repercussions, I think, for our sovereigns in the region. Jamaica has distinguished itself so far, having come off of years of discipline, as I think being one of the sovereigns who has neither had a rating outlook change or a rating outlook downgrade in the face of COVID. And certainly, you know, we know a couple have come in for watch recently. So the impact of a full hard-on recession for 12 months more, I think would begin to test both sovereign and client and issuer and some of the weaker balance sheets. Having said that, I want to acknowledge that we take it for granted, but especially in terms of our larger commercial franchises, if we look at it, the capital base there is quite deep, but again, capital liquidity, 12 months or something unprecedented. So I would hope the 2022 response is simply that I don't think we'll be back to 100%, but we will at least be treading water.
Yeah. Yes, agreed. You had something, you had a comment, Dane?
Yeah, no, just quickly. I think also included in how quickly we'll take to get back to normal is what that new normal will look like. There are a lot of things, even from a social perspective, that we've had to be doing differently. And the question is, how much of those are going to be elastic and how much of those are going to be plastic? How much how much of what we're seeing is going to be permanent, and how is that going to really change the way we interact, and just generally speaking, how the various variables work. I think it'll be very interesting to see.
Yeah, agreed. You talk about operational risk, and I think I mentioned in my opening remarks about what's potentially the new normal with working from home paradigm. There are many organizations now that are even contemplating making it more of a permanent consideration for their within their organizational structures. And some persons are looking at merely extending it into 2021, and some even just beyond 2021, until persons are assured that the risk level for contagion has been reduced. But certainly that's a consideration for everybody. What is our new normal going to be when it comes to how we operate our various businesses? All right. Very, very interesting discussion there. We'll use the opportunity now just to segue into just having some further discussions based on the presentations that have already been made by each of our panelists. Now, based on the discussion around interest rate and liquidity risk, Dane, you shared with us that this is a perfect opportunity for us to use this opportunity to look back at our data points and to build resilience using greater effective and ensure that we have greater effectiveness in managing similar risk events. I know we said that we have in the Caribbean region, we're exposed to different types of risk events, but certainly a pandemic is not a frequent event. And one of this kind of magnitude may have been maybe about 100 years ago. And it was at a different economic time or time within our history. Certainly, from a global perspective, travel is far more easily accessible by persons, and therefore the spread globally certainly took a much shorter time than would have obtained 100 years ago. So conditions have changed, and the conditions would have made this progress much faster potentially than it did 100 years ago. Given that perspective, what perspective do you have, or how, if at all, has this kind of crisis or any crisis at all made you think differently about how to manage interest rate risk? You're on mute, Damion.
Oh, sorry. No, I think the main thing that you see, and it's probably common to liquidity risk as well, is largely really the difference in how you really look at behavioral factors. We kind of have some a priori assumptions in terms of what different type of client types will look like in terms of their relative levels of volatility, what the attrition will be, what the interest rate sensitivity will be. But I think when you actually look at this, and this kind of really gives you a good data point again for any future stress tests, or at least things to consider. You see that even though the experience across broad categories may be somewhat similar and what you're used to, but then you really start looking at those real pockets within those various counterparties that may look a little bit different. So, for example, the definition of financial institutions is pretty broad, but not necessarily all of them have the same liquidity profile or even or attrition profile. So you start to look a little bit more granularly at those and start to model those differently. That's probably one example. Even on the liquidity side, I mean, you can have a renewed focus on asset liquidity and sort of incorporating those considerations into how you scale other risk metrics. I mean, since assets are a lot less liquid in a crisis, I mean, the persistence of any stress on your various portfolios is going to be a lot greater. So those are kind of some of the ways that you've kind of had to be nimble in this situation.
Yeah, agreed. Thanks for that. And Damion, you spoke about ensuring that there's a good level of diversification within a portfolio across your asset classes. I mean, we speak about liquid assets, and typically liquid assets provide low returns. That's basic during normal times, but certainly to facilitate greater opportunities during disruptions. How does one consider that kind of balance? How do you strike that balance?
Okay, as you said, Hope, we normally look on returns from liquid assets from a static perspective in terms of how much you earn on a bank account or repurchase agreement or government bond. But I think one of the things we have fundamentally missed is that it ignores the optionality it can give a portfolio with respect to buying assets at depressed prices when markets freeze up, or even just the mental comfort to not consider having to sell assets to bolster cash resources when there is a highly uncertain outlook for the future. And I don't think that we have priced that in appropriately in terms of constructing portfolios. Some have focused on the benefit of liquid assets with respect to the negative correlation during times of crisis. As we know, for example, US and UK government bonds are highly sought after during these times, and the prices increase, providing a bit of offset relative to the declines in the price of other assets. But what is really ignored is the optionality that the cash provides. The cash isn't just necessarily cash throughout the life of the portfolio. It really gives you the ability to make a decision that you have when it is most profitable to be able to make that decision in terms of acquiring assets, sometimes even very high quality assets that others are forced to sell or at least are unable to purchase in the market, giving you the ability to bid for them or negotiate around them. Clearly, this is not a recipe to time markets or any kind of indication to actively trade your portfolio every time there's an emergent event or some little volatility in the market. But you can consider the positive return that liquidity can generate, and to less determine and see it as a drag on your returns, or as some people see it as the cost of insurance against risk. The disciplined approach to deploying such liquidity in adverse markets would have to be developed as well, because given the significant volatility that occurs during crisis, it's really a fool's errand to plan that you can call when the bottom of the market is. If we look at where asset prices are now relative to the lows in April, it really is remarkable in some instances, even when you consider the policy response. And one of the things we note is that outside of the technical implications, including the lack of liquidity that drive asset prices during a crisis, the fact is also that at the end of the day, we're social creatures and belief kills and belief cures. When there's that panic, when there's that fear, that's going to drive asset prices. And when there is more a stable outlook, that will help some recovery. Being able to predict that is difficult. Policy responses, yes. Fundamental outlook, still quite difficult. But again, that's a disciplined approach in terms of determining the amount of liquidity and seeing it not just as a drag, and how to deploy that liquidity during adverse circumstances. When there will be fear, people will want to hold much more liquidity than they would have before, rationally, and probably much more than they actually need, not knowing the shortfall. This is less of an issue for regulated institutions, because that liquidity is very important. But in terms of other portfolios and return generation activities, when you redeploy that liquidity to generate long-term returns, having a disciplined strategy around that beforehand is also quite useful.
Yeah, thanks for that. And as a matter of fact, Damion, we've seen in our markets here where at the onset of the pandemic back in maybe February, March, you started seeing asset prices, some of those asset prices starting to tank, particularly on the stock market. And that's coming from an extreme high, within 2019 into early 2020. Persons have also learned, I think, within a very short space of time, since the onset of the pandemic, that it makes no sense panicking, no sense without taking on panic buying or panic selling at this point in time. Just hold your ground, contemplate making investment decisions based on the fundamentals of assets to be incorporated into your portfolios rather than the technicals. And there is where you will see the value over a medium to long term. So you're absolutely correct. Monique, from a credit risk perspective, you have shared with us your insight on just taking into consideration the client's perspective and the regulator's perspective. Now, what are some of the credit risk related implications for financial institutions to consider if COVID-related businesses and employment credit conditions do not normalize by the start of, or at least start to normalize by 2021?
Thanks. So there's a Stephen Covey quote saying, begin with the end in mind. And I think from now, all banks need to be doing that. So that if we come to the beginning of 2021, all the touches, everything you're doing now, I think it was Dane who referred to it, those data points, what is happening with your clients, you need to have that ready and understand that, so that when it comes to 2021, both for your own next steps on strategy, or assuming this is an exogenous event, which is not caused by inherent client uncreditworthiness, and there is more credit risk mitigation needed and support from stakeholders like the regulators, you are ready with factual information to begin to, for your own self, analyze what the next step, right thing to do is, and also for your internal governance, your senior execs, your board, and for your regulators, because again, we are in a world where we're, as credit risk people, we don't kick the can down the road, but we also do not work with rigid, black and white. We seek to understand our customer, we seek to understand what is happening and move from there. So what I would say is right now, begin to ensure that as you're walking through the process, it's not just about doing something today, but it is about gathering those things which will allow you to assess for the next 6 months, so that at the end of those 6 months, you are ready to determine what is the next path for, and there will be different clients who have a right path, but to engage in that conversation and to bring it to your industry associations also, because I think that is one of the powerful opportunities. We've been talking about what are the opportunities out of crisis, and we've mentioned, well, coming back to basics, but also I think a part of it on this thing about how the new normal is, how do we get data points together so that it's not institutional information only. And I think that's an important one that may come to, if this thing goes on for longer into 2021, to have industry.
I think we're hearing some feedback.
To have ways in which the industry is able to collaborate to ensure that we put forward, if that is what is warranted, the most robust and data-driven rationale for where we are going to go, because by definition, it will probably be uncharted territory in terms of the support we'll be asking our regulators to tolerate us to give.
Yeah, thanks. Thanks for that, Monique. And I think as well that would certainly impact the strategic direction for those organizations once you start taking those implications into consideration.
Yes, and I think that's an important thing that all the orgs are doing and are trying to do, is not just look at the short-term implication of what they're about, but both the short-term and the longer-term. What's the implications? And I think COVID has reminded us, no institutions are island, even the strongest one. And that's not just about surviving it, but it is about, you know, as I gave in the Bear Stearns example, we've been reminded that it's not just about if I get COVID in my house, but what do I do to the community if I don't know I have it? So that there's a certain amount of interrelationship and community, which I think COVID has reminded us. And I think that comes back also to the financial institutions in terms of how we are trying to treat with the clients, but also how we are talking amongst each other to really understand what is going on and do what the right thing is.
Yes, absolutely. And whilst we're on that, potential changes to the strategic directions, you know, IFRS 9 provisioning is a key consideration for credit portfolios. What's your view on the key success factors in handling IFRS 9 provisioning from the Caribbean's perspective? Do you think there's sufficient information to move forward, looking at to make forward-seeking assessments on the on models?
Yeah, and I remember, who was it? Damion mentioned, or I think it was Dane who mentioned the models and the need to really rethink what is in them. But what came to mind when he was speaking was the way in which models that have been on paper are now coming to life. There are a lot of people who are making models who don't really understand what that number means. What does that haircut mean? Oh, it seems pretty aggressive, but you're coming to real life now. So to transition that to IFRS 9, which is a significant leap forward in terms of what I would say the modeling beneath provisioning, right? Before it was 90 days and you are classified. Now it's stage 1, which is our, you know, call it performing, everything is fine. Stage 3 is now what we would have called kind of non-performing. And then we have this in-between world where you're not non-performing, but something about you has changed. Do we have enough info? I think this is where and why the CFA is really relevant, Hope. And I mean that because, yes, we do. It's just like, as was mentioned, some companies have thrived in COVID because they had the backbone to be technological. So it's about what is the objective that I am trying to build in terms of an IFRS 9 model. And it is precisely for events like this, so that even before a client has come and gone to the most deteriorated stage of creditworthiness, you are beginning to recognize credit deterioration, which is material. So you rather than have a cliff event in how your stakeholders are reading your financial records, they're able to see and go along with you. And also, to be fair, it drives your internal management behavior because you are incentivized to not have that stage 2 evolution crystallize. So we have the talent and the ability to find the data we need to create robust IFRS 9 models. What we need to do is really make sure we have done that and become much more, I think the tone from the top in some places is not right around IFRS 9. I think certainly there are banks that are, as I've mentioned, are well ahead of it, but I think some areas probably need, in terms of in the Caribbean, to give a lot more emphasis to bringing the IFRS 9 provisioning up to par. And that involves, 1, having a clear policy on it. IFRS 9 forces you to make explicit what it is you are doing regarding provisioning. It forces you to think through how and when you call those milestones in credit deterioration and to put those and make them transparent. it does allow you, as you will see in COVID, to do what we call overrides, to say, you know what, I kind of thought that half a tank was really a big issue, but based on what's going on, quarter tank is okay. But what it means is that the robustness of how you record that from a governance perspective, you have to think that through, you have to bring points of reference to bear, and you have to make it documented so someone can see your rationale. So the other aspect that I think is really important for IFRS 9 in terms of, apart from the policy, making sure you have a clear explicit methodology, is frankly having more persons at the table. I found that in the old provisioning dispensation, you might have one person kind of over here, a very siloed world. IFRS 9, if you're doing it correctly, probably has a lot more interplay between internal stakeholders in the institution, so that you can have challenge around what you're thinking. And so there's a richness there. And secondly, I think finance and risk come together a lot more in the IFRS 9 context. And I think that is an important part of the IFRS 9 being well done by an institution. And last, the capabilities. Do not try to skimp on it. There are, whether it's experience, and some people, again, it's a new thing, so it's not, you might not have been there, done that, but there are actuarial risk and certain capabilities that are necessary if you're going to do IFRS 9 correctly.
Great. All right, thanks for that, Monique. Just want to remind our audience that we're open to further questions. So please feel free to share your questions using our chat group. We have time for some additional questions, so please feel free to use our chat group to share your questions, or even your perspectives, if not a question. Now, Monique, I know you've shared quite a bit on credit risk and the exposures and some of the considerations that the institution should take. Well, some of the things the institution should take into consideration in planning around credit risk exposures. Now, the reality coming out of COVID, though, is that we recognize that some of our clients have been significantly impacted. Or their business operations have been impacted. Persons have been impacted with job losses, and therefore unable to service their obligations to various financial institutions. Now, invariably, that also impacts the level of liquidity that institutions, or potentially impact the level of liquidity that institutions would have. Now, the question around that, though, is, based on that level of impact, what would you say best guarantees that an institution's liquidity contingency plan works? And that's assuming that the institution has a robust liquidity contingency plan in place. But what would you say best guarantees that a liquidity contingency plan actually works?
Thanks for that question, Hope. So, I spoke about some of the aspects before in terms of, ensuring it's well thought through, and, having liquidity in terms of, having flexibility in terms of, how we think about different client profiles. But I think, one key thing also is just really ensuring the actual operational capability, of your recovery options. You in your liquidity contingency planning, you would have, various recovery options, depending on which stage, that you would look to, depending on what the nature of the crisis is. But it's very important that you're able to access and actually get to them very quickly. So even simple things like if it is that you need to apply for a facility, what information do you need? How do you actually get that going? if you need to have coordination between subsidiaries, how is that going to actually really operationally work? So it's really ensuring, you know, I think this particular thing where we are now, you know, in the stage of the crisis where it's kind of like a steady state crisis where, you know, the environment is and the exposure and the threat is still heightened, but it's kind of in steady state. So it keeps it enough top of mind for that focus to really sort of continue to say, okay, now that we've kind of secured in terms of having the amount of liquidity that we're comfortable with, how do we ensure now that the actual plan that we've put together works if it is that the crisis escalates? And I think, you know, in other cases, even in terms of business continuity planning, I think, you know, we've pretty much had a similar, we're kind of in a similar type of paradigm now where we can really take the time to ensure that our plans work. One other thing in terms of contingency planning, you know, that I think through as well, you know, even in terms of, you know, even from a portfolio perspective, you know, it's useful that those plans are really in place, you know, because again, you know, in terms of holding ready reserves for very extreme stress events, usually, you know, particularly from a portfolio perspective, you know, that are the times that won't necessarily be the case, right? Otherwise, you'd have your entire portfolio in cash. So, you know, your contingency planning becomes really, really important, you know, in these kinds of states of nature. And, you know, I've a kind of undeveloped thought, but, you know, to the extent that you even look to gather opportunities in the face of these situations, you know, we always think of contingency planning as a kind of defense mechanism. But, you know, it can also, you can almost probably even think through what a prospective contingency plan would kind of look like. You know, how would you go about accessing additional liquidity, you know, in the face of these particular situations where opportunities present themselves to take advantage of opportunities. I mean, obviously the range of options will be the same, and a lot of them won't be available to you. But you know, it's a undeveloped thought, but I think it might be a useful thing to think through.
Well,
okay.
just to add though, Dane, on where you were going and the undeveloped thought. Now, I think it's a good one because, you know, we, again, coming back to some of the institutions we know, proactive risk management, proactive contingent planning, which to your point is operationally ready, actually has a cost of capital benefit, right? Because you are known to be so resilient that in fact parties and counterparties come to trust you, and there are a number of players who are like that. So I think that, yes, you know, it's not to overdo it. We're not going to all become hoarders of cash, but that ability to show management through crisis and through contingency events really does have a tangible return to it for a lot of institutions, because they become the one who can get capital at very low cost, because people understand that they understand how to one, be there through the long haul, and two, really allocate capital in a smart and sensible way.
Okay, all right, great. All right, thanks for that, guys. We have one question here from a member of our audience. What are some leading indicators of liquidity and credit risk that are getting closer monitoring or scrutiny during this crisis? And how are financial institutions reorienting their response mechanisms to treat with potential fallout in their portfolios in relation to those leading risk indicators?
You want me to go first?
Yeah,
absolutely.
You can go first, Monique.
All right, so leading indicators. We are looking a lot more, and I'm not sure I'm repeating the leading indicators because I'm not sure it's a leading indicator, but certainly we are looking a lot more at cash and liquidity. And you could see it, you know, to be fair, we've discussed it. We've had a pretty tolerant market in the last 5 years. We have seen a lot of covenants and terms and things get negotiated down. I think a lot more attention is being paid to that, notwithstanding that, of course, we are being gradual about returning to that because we understand we're in the middle of a crisis, but in the normal time covenants that we are putting forward now, focus a lot more on what I would call the back to basics terms and covenants. Secondly, leading indications around management. A lot of this is about management. Who is there, who has been through. So at a firm-wide level, that would be some of the things. In terms of the bigger picture opening up, we certainly, which I think affects, because the exogenous shock, a lot of it is not necessarily driven by what is happening at a firm-wide level. For Rosier Day, we're looking at how countries and sovereigns are responding to, one, the crisis as a health factor, but also how they are managing themselves and their economies through this. So I think that's also something which we are considering at this time.
Okay, thanks for that, Monique. Dane?
So I think a couple of things that I look at, and I mean, I guess I probably go back to, you know, what typically would precipitate a liquidity crisis, and like I said, it's usually a function of surprises. No, most surprises that you find, or most crises that you see emanating, present themselves as surprises, but they've really been brewing for a long time. So you rarely find crises that really build overnight. So I think, you know, some of the things that you really look at is, you know, just, you know, I guess, you know, structural weaknesses among you know, various players in the market, or even in some cases, you know, what might be perceived as a lack of, for lack of a better term, a lack of discipline in markets. So for example, if you see, you know, where, you know, traditional, or you know the type of assumptions and the type of behaviors, I mean, that you'd expect, and behavior responses that you'd expect to see, you know, in markets start to break down to the extent where you know, it becomes, you know, very much proliferated throughout markets, and you kind of see that herd mentality, you know, usually, you know, I mean, obviously you have to think critically about it, because in some cases, some of those assumptions need to go. But, you know, when you start to see that, then you start to look at things a little bit more closely, and then examine them a bit more, and, you know, say, you know, is there some fundamental weakness sort of building up here that will eventually culminate into something that could be disastrous. So I think, you know, that's one perspective I give.
Okay, thanks for that, Dane. Damion?
I think going back to Dane's comment, there are some typologies in terms of high risk exposures or imprudent behavior that arise. For example, when you hear people saying that an asset price cannot fall, that's normally an indication. So when you hear people say land stock next, so it must go up, and people's expectations are that it is in the teens, that's automatically you buy it this year and you'll make a 20% return next year. That's indicative of either robust underlying activity or liquidity conditions or expectations going forward. And as Ian said, there's no set price that says it's a risk, but you need to examine a bit more. Or you see professionals across the sector agreeing that things may be overpriced, or being a bit concerned about particular markets, but those markets just continue to move. That's also a reflection of either there's not a long-term perspective, or maybe there must be some other issue driving it. The other aspect that drives markets is also liquidity. Liquidity needs to find a home. And when there are clear signs that, whether because of regulatory constraints or otherwise, people are buying assets that they don't really fundamentally like or think but the price went up recently, and therefore it's likely to go up. So I'm joining the herd. That's also a time to pause and reflect. Or where people are complaining about a cash burn. And these are not necessarily risks, because in the benefit of retrospect, when we stabilize its IMF and liquidity conditions are improving, it would have been a great time to buy stocks in a very aggressive manner, not just because it happened, but with the conditions. But it's something that you need to ask yourself as to the why, and to be comfortable that if somebody else from outside, whether the sector or the country, came in and saw those figures, that they would think it's within the realm of reason. If not, you really need to think of, are you that special, or is the asset that special, or are you just in a phase?
Yeah, absolutely. All right. Thanks, team. We have one, while the poll question is still going, asking everyone to just look at this poll again. We have one final question that we'll take from the audience, and that is, can you describe the various approaches institutions and businesses can take to attain more liquidity or address liquidity concerns if they're cash strapped right now?
Oh, I guess that's probably a function of the poll results.
Yeah.
Well, well, I mean, I think, you know, well, in an ideal world, you'd have done a lot of the things that you'd have needed to do already. And I mean, you know, the factors that I'd have mentioned, you know, as far as contingency planning are sort of pretty similar. You know, thinking through, you know, what your plan would be, you know, testing it, all that type of thing. I think, you know, one of the key things, and I guess it kind of cuts across various areas, you know, are just the relationships that you sort of maintain. You know, ideally as a business, you want to ensure that you have you've cultivated, you know, your access to cash, you know, in different ways. You know what I mean? So in terms of different lines that you have, and, you know, in terms of, you know, your supplier relationships, if it is that, you know, you need to shorten your working capital cycle by you know, getting more favorable sort of supplier terms, different things like that. But, you know, a lot of it you'd have looked to have done, you know, beforehand. But I think, you know, it's really, you know, cultivating those, you know, those various means of sort of access to liquidity, you know, through a lot of the relationships that you have established. I think, you know, is one key thing that you could look at.
Okay. Any other perspectives?
No, just to reinforce, as Dane said, it's an expensive time to want liquidity when everybody wants it. So it's always going through it. But in a time like this, relationships do matter. So that's kind of where you probably would want to look first. Where do you have the relationships? And sometimes that's either not your obvious paths, but paths like people who you deal with on the supply side, or do not ever be shy about going to your financial institution. A financial institution wants to hear, wants to know, wants to have a chance to help you while they can. So I always encourage people, the worst a financial institution can say is no. But very often, I would say at least 50% of the time, people who could get a yes from a financial institution fail to go forward and ask, and they wait too long. And by then it's too late. So I would say still, once you have a relationship with a financial institution, especially, and this is why people, when they multi-bank, you know, it's always important to remember back to relationship, have a primary relationship with a bank, because at times like this, if you're their client and you're their primary customer, this is where you pull those chips out. And so I would also say, don't overlook your primary bank. Put your cards on the table, be prepared. And if you really need that liquidity and they can see where you will be able to get through it with that help, I think you have a good chance of getting help.
Okay, great. Thank you, Monique. Thanks, Dane. Thanks, team. Do you have any final words for participants? I mean, before you even get into the final words, the poll results I'll just share here again. So we redid the poll on what risk do you believe is of most significant concern to your organization during this COVID pandemic event. And if you recall, I'll just refresh your memory. When we started the discussion, we had an almost, well, an even 35% on credit and liquidity risk. We had 23% on interest rate and market risk, and 32% on operational risk. Now, having had the conversation and shared some perspectives, we're now seeing 60% seeing liquidity risk as the most significant concern, 31% showing credit risk, 19% operational risk, and 8% on interest rate and market risk. So the takeaway, most persons are feeling the liquidity pinch. All right.
Convince themselves.
All right. Any final perspectives from our team?
Okay, I'll go first.
Before we wrap up.
I think there's a cliche, but a very important one, that never waste a good crisis. In the context of the lessons from COVID-19, I think it is a good opportunity to just step back, no ego, look back in terms of how entities performed, how your partners performed, and say, with the benefit of hindsight, we couldn't have predicted this, but there's something fundamental that we weren't doing correctly. Secondly, also, even as we do prepare for further volatility, and that's my view, that there will be volatility, it won't just be smooth sailing upward, to ask yourself, how do you discipline yourself to maintain your risk exposures, even as you pursue profits, but also to cue when it's time to take some of that risk, because the medium-term outlook is biased towards you making money on that over time as well. So it's not a matter of only hunkering down when there's risk. You have to be prudent, but also taking advantage of opportunities. And also that outside of the financial aspect of it, I think it was Monique that said that relationships matter. Taking the time during this period to build key relationships and to restore key relationships. I know that for a fact that for those within the sector, and especially the firm I'm part of, sitting down and understanding what your clients are about, what their needs are, and what it will take for them to flourish over the longer term is important. I mean, business will continue. Life has changed. This has been a significant event, if not unprecedented in modern times. But life will continue. We just have to find a way to make it work as best as possible.
Yeah, you know, I definitely echo, you know, everything that Damion has said. You know, so, you know, it's really a good time to, you know, like, you know, Damion said, never waste a good crisis. So it's a learning experience. So you rethink your assumptions, try to think through, you know, what parts of the changes that we've seen are really temporary for an unusual sort of business discontinuity-led crisis versus what is going to be permanent. You know, sort of really reevaluate, even on a personal level, you know, evaluate what your risk capacity is, and, you know, and be very, very disciplined about, you know, how you use that going forward. And, you know, definitely, I mean, again, you know, this is an unusual circumstance, and, you know, it's hard to really to be permanently positioned for severe circumstances. Usually we position for moderate ones. So, you know, really and truly building strong contingencies. And I mean, it's, you know, we talk about liquidity contingency, but it's contingencies just in various aspects of life. For the same reason you do, you know, earthquake drills and have, you know, emergency management is a similar concept. So really kind of having that those contingencies in place, and, you know, ensuring that you can execute when the time comes.
So ditto to Damion and Dane. I would say, okay, then, so for me, then I would focus my comments on resiliency and learning. So at the personal level, you're never gonna probably hopefully live another time like this. So if I'm a young professional or somebody in the industry, any company, I'd really learn from whatever is happening now. If you flip its head, there are opportunities. You know, we talked about opportunities. I know I smell that part of watching institutions who months before to do something, who had to relocate. They figured out how to make the same thing that would take a month with many explanations. They figured out how to do that well in 2 days. And so the opportunity is, how does that become a way of being? How does that become not crisis driven, but opportunity driven, which is revenue driven, which is client driven? And that is a challenge which I leave for people at a personal level, at an institutional level, but also I think because we're in a fabulous place nationally in terms of where we can go with our economy and where we can go with our industry. It's a generally growing and developing and maturing one. I think we need to underpin that growing sophistication and etc. within the industry in terms of a number of opportunities, and COVID has taught us how to be agile and how to collaborate more. So lastly, resilience wise, data and technology, how do we bring that to allow us to learn and have that data encoded. So whether it is to enable a process for a client or the processes for the industry or the way in which we make sure people can get accounts or financial inclusion, how do we take that into post-COVID and how we operate at the industry level?
Okay, thank you. Thank you, Monique. Thanks, Dane and Damion. I think to wrap, the takeaway for me is really, there's opportunity in every crisis, right? And for each and every one of us who has participated in this, conversation today, just take the time to review your strategic imperatives based on, your assessment and understanding of how this crisis actually impacts your business or your institution as risk practitioners. And just implement some strong, or seek to implement some strong contingencies and solid planning for the future to help to grow your organization or to grow your business. So we do hope that you have garnered quite a bit of practical insight to help better identify and manage various risks that may increase or emerge during crisis times like these. And we look forward to having more conversations on some pertinent issues impacting our financial markets. So thanks again, everyone, for your participation, and see you all soon. All right, thank you all.
Okay, all right.
Bye.
Thanks and bye.
Bye.
Okay, good night, guys. Thank you so much. You all were awesome.
Thank you.
All right.
I think
Thank you, Dano.
no problem at all.
Yeah, man. I wasn't seeing some questions though, so I'm not sure what was happening.